Good morning, everyone. Thank you for joining us this morning. So I want to welcome you to one of a new series of briefing events that our firm has presented on the crucial topic of social and affordable housing in Ireland. So in April this year, we presented an event on affordable housing and the Land Development Agency with speakers that included John Coleman, Chief Executive of the Land Development Agency. A couple of weeks ago in May, we gathered a panel at short notice to discuss the announced stamp duty increase for bulk purchasers of houses in Ireland. We've also presented an event on strategic housing developments and the reason that these provisions are being quashed at the moment. And there will be more to come, perhaps on the construction industry and financial and social housing. However, the focus of today's session is financing. So financing the delivery of social and affordable housing. And I think that anyway, you look at the financing question, whether the state does it alone, whether the state does it in partnership with either the private sector or voluntary bodies or both, it's clear that the delivery of social and affordable housing has been insufficient to meet the country's needs. So this morning we had a headline on RTE saying that Davy is estimating that over 200,000 housing units need to be built over the next 3 years to meet demand. So the interesting question we want to ask today is whether there are models in what the leading voluntary bodies are already doing in Ireland and what our neighbours in the UK have done over the past decades that we could do or adapt for the Irish context. It's not really a legal topic, and we're very lucky today to be joined by leaders of two of the developing approved housing bodies that have been at the leading edge of developing new structures to finance social and affordable housing. Brian O'Gorman, CEO of Clúid Housing, and Sharon Cosgrove, the CEO of Oaklee Housing. And we're also joined by two financial experts with particularly interesting expertise from our point of view in advising the social housing sector. So dialing in from London, with UK experience is Antoine Pesenti, who's the head of capital markets at Gresham House PLC, and Fiona O'Driscoll, who's recently joined Appian Asset Management as fund manager for real estate with focus on social housing. So Brian, I think I'll turn to you first to set the scene. Can you give us some background on the AHB sector in Ireland, the role it plays in the provision of social and affordable housing?
Good morning. Yeah, I suppose it may surprise a lot of people to realise that housing providers or not-profit housing providers have been in existence for a very long time. One of the first ones, the Ivy Trust, which was established in the 1890s, began building and providing accommodation for the Guinness workers before the foundation of the state. Now, with the creation of the state, that role changed and was subsumed by the municipal authorities. AHBs or housing associations came back in then initially in the 1980s to provide niche accommodation for people who were falling through the provision that was there then, mainly housing homeless households and niche or households which were had particular difficulties. And then in the 1990s, housing associations became associated with general needs housing. And last year, they would have provided 40% of new long-term housing for social housing. And that's a model which is more similar to the European model.
Yeah. So what you're describing there is a trend to get to 40%. There's a national context for the move away from exchequer funding of construction of social housing and towards the financing of AHBs. Can you just give some of that background?
Well, the change really occurred as a lot of things changed when the economy collapsed in 2008. And there wasn't the capital funding available then to provide what we'd been developing using grant funding, so that was no longer available. So the state then turned to what was a debt financing model. So it was housing associations becoming lenders, and that lending being secured by contracts with the state. So we would secure lending and then make that available to the state or local authorities in this case to allocate people from their waiting lists into that accommodation. So the model completely changed. So one of grant funding to debt financing. And that's really the opening then for providers. First of all, the Housing Finance Agency, but then more recently with Legal & General and Nord and other private finances.
Yeah, so can you describe that? So how is Clúid's funding currently made up?
Well, Clúid's funding there's two elements to it. There's what's called a capital advanced loan facility, which is provided by the state. Now that can be up to 30% of the capital cost. More generally, it's around between 20 and 25%. Then there's a senior lender, and this in the early years, this was exclusively the Housing Finance Agency who pioneered this development on behalf of the state to get the model established, and that provides the remaining up to 70% or 70% plus of the lending, and it's over a 30-year term, and the lending is indexed to market. It's indexed to inflation and begins at 92 to 95% of the market rent. So it's a very secure form of lending, and as we found out when we went as we went to the market, it's a very attractive form of lending for financiers.
So you've looked at the private market. Can you describe your experience and what role you see for private market financing of AHBs in future?
Well, I think at this stage, as I said, that the first lending under debt finance occurred in 2012. So it's almost, we're nearly 10 years into it at this stage. So the model is very well established. So lenders or private lenders can come into a very well established funding mechanism, something which is indexed to inflation. It's tied initially to market. It's tied to market rents. So it's a very strong cash flow. It's long-term loans, so it's over a 30-year period. So it's very attractive to a number of particularly institutional investors. So we see the potential as being, there's a significant potential here. It brings new money into the sector, new money into the country. It provides a basis to expand housing, not away from using government finances. So there's a lot of very positive things both in this model, but also in bringing new money into the sector.
Now, private financing, you're talking about entities that are voluntary bodies, very often organised as industrial and provident societies with charitable status. How does that status affect what you can do and the structures?
Well, as not-for-profits, it doesn't have a huge bearing on it. We're housing providers, so we're exclusively one activity businesses, if you like. So everything is connected to our social mission with regard to housing. And we're very used to taking that long-term perspective. So when we offer accommodation to residents, we're making commitments to them for a 30, for a 60, for a 100-year period. So we can only be confident in making those commitments if we're conducting successful businesses. And that's the base on which we operate. There's a famous quote by Peter Drucker that the business thinker, that the basis of doing good is doing well. And we can only do and fulfill our social mission in as much as we're successful social businesses.
Yeah. So I think Benjamin Franklin said something similar, but there's a vein going through thinkers like that. Let's turn to the other major development from the AHB's point of view, the establishment of a regulator, which happened in February, and where there's a sort of slow rollout of statutory regulation. What's that mean for the sector?
We welcomed regulation. It might seem a bit, is this turkeys voting for Christmas? But what we need with regulation is it reassures lenders who are working with the sector. It also provides that reassurance to the public that these are well-regulated bodies. These are bodies that can be trusted And ultimately, that's what our reputation is built on, that we're bodies that can be trusted. And up until the establishment of a statutory regulator, we didn't have that independent assurance that investors could, and the general public could rely upon when dealing with housing associations, and knowing that they were well regulated bodies who are accountable.
So from Clúid's point of view, statutory regulation is probably a net plus.
It's hugely welcome, and as I say, for the investors, it was an important element to them when they knew the regulation was coming. It was an important aspect for them to come on board.
So do you want to say a few words about policies affecting the various types of tenure, private rented, social rented, owner occupied housing? Are there any imbalances you see there?
Well, I'm firmly of the view that the different housing tenures are all interconnected. So if we're going to have a successful housing economy, then all the different parts of that housing economy need to be working well. I mean, we see it in terms of the supply problems with the owner occupation sector. That leads to more people renting, problems in terms of supply of rental accommodation, increasing in rent. So they're all interconnected. Where we see that the social housing has to be run efficiently, has to be run well, has to be flourishing in order to play its role in a successful housing economy. Where I suppose the missing piece for us for a long number of years has been cost rental. That segment of the population which isn't poor enough, if you like, to be on the social housing list, isn't rich enough or has the means to survive long term in the private rental sector. And this year, the government are funding the first cost rental space. So we see that as probably meeting that large vacuum that has been there in the wider housing economy. And again, that would be a model which is common throughout Europe. Yeah,
so you're kind of saying you can't have a healthy sector in general if one of the subsectors is dysfunctional.
Exactly.
It bleeds over into the others. Yeah.
Indeed.
Yeah. That's great. Thank you very much. I might turn to Antoine Pesenti next, who, as I said, is the head of capital markets at Gresham House PLC. So Antoine, before the financial crisis, UK housing associations, which are the equivalent of approved housing bodies, were largely funded in the same way that Irish AHBs are funded right now. So a mixture of government grant and long-term bank loans. Can you give some of the background to how capital markets funding for UK housing associations developed since the crisis?
Yeah, thank you, David. We started raising funds for housing associations in the early 2000s. And at that period, I'm not sure that Irish associations are so lucky now to get the same terms, but we would get long-term bank funding with light covenants. And interestingly, terms were getting better and better when we reached 2008, 2009, where we could get 30 years plus margin went down to 20 base points and covenants like interest cover very light to meet. So it was like fantastic. And at the time you couldn't beat that with the capital markets because no investors would lend at such low level. Then the crisis came in and banks have pulled out of the market, and for the long-term market because of this liquidity requirements. So all what we do with banks these days is to do RCF up to 5 years facilities. There are plenty, they are good, useful, but for housing associations, having long-term assets, you need long-term debt to match it. You just can't take this refinancing risk. So hence the solution to go to long-term investors directly, not through the banks, and get this long-term funding. So that's how we started in 2010, 11.
Yeah. So explain then how a capital markets funding transaction works. Who are the borrowers? Who are the lenders? You're talking about approaching lenders directly.
Yeah. So the key again is it was all about long-term debt. So it means that the investors have to be interested into long-term investments for their side. So they are the natural end investors are the pension funds.
Yeah.
They need to pay our pension for long term. So they are there. Then you got the insurer market that's played a big role. The buyout pension insurers. So the one going to BT or big corporates, taking the responsibility for your to pay the pensioners. That was it was a big change because this one as well, they really need to match the cash flows. They are like a cash flow liability matching. So for them, they can't just invest into equity that many pension funds would do. They need to match it, and the bonds is perfect for that. So there are big players.
So there's not just bonds, there's also been social housing REITs, so equity investments as well.
That's a new development. Bond work very well, but what happens, as you said, the grants has been reduced a lot. So it means that gearing is increasing a lot for UK housing associations. When your gearing becomes too high, then you need more equity. And that's how we trade risk, set up this REIT in 2017, specifically for shared ownership properties, which is a bit like some affordable housing where the tenants have got some stake in the property. And there have been other funds, but you would consider that equity is more expensive than debt. So you would consider that when you reach a bit your maximum gearing capacity or getting close. We know that people would do some JV where they have to pay 15% return on equity, which is very expensive. If you do a REIT, people only need 7% equity. So it's a cheap form of equity, but it's still much more expensive than debt.
So turning back to debt, which is really the success story here. I mean, it's really striking. Capital markets funding is now the predominant source of new finance for UK housing associations. Looking at the figures from the UK regulator of social housing, 66%, 2/3 of new funding for housing associations was sourced from capital markets in 2020. And the bulk, the outstanding amount. So at the beginning of this year, the total volume of capital markets funding that was available to UK housing associations was 48.8 billion sterling. So nearly 50 billion sterling versus around 60 billion in bank facilities. So you really see public markets funding almost crowding out traditional bank lending.
I mean, again, it all started because there's no available long-term bank funding. Our clients kept their old facilities, and that was a big job to maintain them, not to breach anything, and they were extra valuable. But there's no any new funding from banks is maximum 10 years, and even 10 years, the margin becomes quite expensive. Most bank funding now is 5 years, and you can't run a business like housing association where you buy the assets for 50 years with a short-term facility. So it's not that we found like a more competitive way than bank funding. It's just that it was not available in the terms it was used before the financial crisis.
But there are some advantages over bank funding from a housing association as a borrower's point of view. You mentioned the attractive rates, covenant light compared to banks. And you were involved in the early transactions with your firm Trade Risks, which is now part of Gresham House Group, in those early transactions. So that must have been attractive from the borrower's point of view.
Yeah, I mean so the borrowers, we went to the bond market as well. What happens with if you use banks for raising capital markets, they will do like a roadshow in 3 days. On the 4th day, you have to price it, and it's done. It's a 1-week job. But we felt for a market which is not very developed, where there are not frequent issuers, it was better to do like the private market where you meet each investor one by one, take your time, discuss covenants, try to get the best covenants you can get, negotiating, and then selecting the investor and doing a transaction. So that's why we felt we could add value compared to banks doing the as a book runners.
And are the housing associations issuing bonds in their own name, or are you talking about multiple associations?
Yeah. No, definitely. All what I mentioned is own name funding. And again, yeah, they can be small. They don't have to be very large, and it might go to one investor, but it's still done on the listed bond format or private placement formats. You do have aggregators, and it's interesting that aggregators actually started even before the boom of the bank financing in the early 2000s, like in the 90s, is where THFC, the main aggregator in the UK, started.
So are you talking about a sort of consortium between multiple housing associations or a separate funding entity?
Separate entity. It's a bit like a charity, but they're aggregators. So they will go to the capital market, raise debt for this kind of SPV, and then they will on lend to many housing associations in terms of loan. At the time, it's done on a cash flow basis, because again, the sector was not very developed. So corporates in the 90s, it was a bit tough to directly borrow. And this one was early days of financing, done on a more like project finance basis, which is a bit where I guess the Irish market is.
Yes, so I was going to ask you about that. The Irish market, this isn't something that's currently done. What were the preconditions that were necessary for development of capital markets funding in the UK?
Sorry, what were the conditions for the success?
Success, exactly, the development.
Yeah, I mean, it's, you need, history. I mean, that's, again, people are investing for 30 years, so they need to be quite confident that it works, that is very safe. All these investments have to be investment grade, which means like if you had the rating, grade rating, it would be like a high level, because you have to cover pensions. You just can't say, sorry, there's no money for your pension. So it's, you need history to be reliable. You need regulator as well, established. Is actually what Brian said. I mean, for lenders, having a strong regulator is very useful. When you do the credit rating of a housing association in the UK, you got uplift about 2 notches thanks to the regulator, the government support behind that. Without that, there would be hardly be investment grade. So it would hardly work for long-term investors who want like very strong credits. So again, the regulator establishment history is very important.
Yeah. So those are really the developments that would need to happen here before, because we have a developed capital market, of course, one of the biggest debt capital markets for other countries' pension funds to raise finance.
But it's and as well, I guess, size. I mean, right now we are raising 100 million debt for Northern Irish housing association, and you would believe it's very close to English housing association. The regulation is very similar, but still half the investors would not look at it just because it's a small market. They don't fully understand how the regulator works because there are differences. But the benefit of Republic of Ireland, at least you got a big capital market, much bigger than Northern Ireland. But you need a bigger size in the market for the housing.
That's great. Thank you very much, Antoine. And we may come back. I just turn to Sharon now, if that's okay, to talk about her experience leading Oaklee, and in particular, your experience with the Acorn SPV. So a type of private market funding through a particular vehicle. How did you go about putting it in place?
Morning, David. Around 2015, 15, 16, Oaklee developed a new corporate plan and with, I guess, quite ambitious targets for growth. And at the time, I think, as Brian explained, the only funder really in terms of debt finance was the Housing Finance Agency at the time. So from an Oaklee point of view, there was an interest in getting long-term fixed rate funding to diversify our funding base. So our Treasury advisors at the time, Centris, assisted us in going to the market really to see if we could secure a facility or long-term finance that would help us achieve our development ambitions, but also get this fixed rate finance and diversify our funding base. So they ran a competition and went out to the market. There was quite a bit of interest, and through that process, we narrowed it down, and in the end agreed a facility, a 50 million facility with Nord LB. The structure we put in place, which I guess was because the rates were very favourable, it was on the basis that we would set up an SPV structure, which was obviously something they were keen on, but also from our point of view, from an Oaklee point of view, was of interest because it was there was limited recourse really to the Oaklee balance sheet. So so from a gearing point of view, that was attractive at the time. I think during 2016, the sort of national policy context as well, from a housing point of view, there was an interest in SPV structures. There was an interest in exploring off-balance sheet and off-government balance sheet options. So these sort of things were all sort of coming together at the time, Oaklee's ambitions and our corporate plan, and also the sort of government policy context. So we, I think we closed in December 17, we reached financial close with Nord, and then over the course of the sort of 2.5 years after that, drew down from that facility, and at every drawdown we fixed the rate. So we get a facility, we got the security of a facility, could enter into, you know, negotiations and contracts on our program. But also we had this security in the background of knowing that we had that facility there, and we knew what the covenants were and what the requirements were of Nord. So it worked very well from our point of view, and hopefully from Nord's point of view as well. I mean, one of the things that it took an awful lot of engagement with the stakeholders, with the Department of Housing at the time, with the Housing Regulation Office, even with the charity regulators. So it wasn't a straightforward process at all. That whole persuasion and piece, or, you know, openness piece to innovation at the time, it was innovative at the time, was a real challenge, I have to say. And that was probably, you know, it took an awful lot longer and an awful lot more engagement than we thought it would require. So that's sort of how we went about it.
Might bring Brian in for his experience on another of the very few private market fundings for AHBs, legal and general. You mentioned them in passing in your initial comments.
Yeah, I suppose first of all, to acknowledge Sharon, who blazed the trail in this and made it easier for those of us who followed and did some of the hard lifting. We went, I suppose, differently. We started off very similar to Sharon, looking at an SPV structure. We moved to a corporate lend. When we investigated it, the rates weren't massively different. And there is a significant administrative burden attached to operating SPVs, particularly for not-for-profit organizations, voluntary boards, and so on. So I think we decided that a corporate lend, and there were a lot more uncertainties when we, at our close, we had COVID was there and other elements which added to the kind of uncertainties. So we went for a corporate lend in the end. I suppose when we went to the market, we chose legal and general. Again, we chose them on purely commercial grounds. Their terms were the best. The rates they offered us were very competitive. But I suppose what we've been very pleasantly surprised since is that as the relationship has deepened, we've discovered, you know, that the values and so on espoused by L&G have been quite positive and quite closely aligned with our own. I don't know if people remember the flotation of Deliveroo on the stock exchange and the statements issued by people like Legal & General at the time. And again, showing the value of, I suppose, ethical investment and the power of investments, if they do get, if they do take certain lines with ESG and so on like that, that they can drive change in the market for the better. Yeah,
ESG investing and the success of that sector and the demand for investment products in that sector is part of the background to the success. I see more and more of the UK bond issuances qualifying as ESG, which restricts you to a use of proceeds and achieving attractive coupon rates as a result. Sharon, back to you, since you blazed the trail. I mean, what were you thinking of there? Were you, was it the role of Oaklee as a developing AHB? Did you see risks in having the HFA as the principal lender to you and to others?
Yeah, I think part of it was sort of, I guess, the risk of having all your eggs in one basket, and that I think is a risk for at the time, not only for Oaklee but for the sector as a whole. And I know others have. I mean, we now have borrowing as well with Bank of Ireland, so it was definitely a sort of risk mitigation piece that was going on within Oaklee. And I think the other bit was the limited recourse nature of an SPV structure, you know, that you were protecting the rest or minimizing the risk to the rest of the business or the rest of the assets or the rest of the tenancies, you know, that we weren't gambling the house, even though we wanted to grow, and we wanted to grow quite quickly. So I think the more funding there is into the market, the better, really, you know, for all of us and for the sector.
So, yeah, I mean, you may face limits soon enough because the AHBRA, your new regulator, hasn't published its financial standards yet, but there's likely to be gearing limits. Do you have any idea of how it's going to exercise those powers?
Well, we know, I guess, the regulation, or ABRA as it's called, is now sort of it's in communications sort of roadshow mode. So they're telling us there will be, you know, as of 2022, there will be 4 standards, and one of them will be a governance standard, one will be a financial standard, there'll be a tenancy standard, and the property management standard. I think in relation to the financial one, we're all watching it very carefully, especially the larger developing approved housing bodies, where there are thresholds in the current financial standard of, you know, for liquidity, for gearing, for debt service coverage ratio. So I guess we probably have a concern if the gearing, if those are hard thresholds, you know, we would like and I think this is the language we're hearing, is that there will be a risk-based approach. It'll be, you know, that there won't be hard limits in terms of these things. There will be a requirement of boards to consider risks, to do stress testing and scenario planning and all of that sort of thing. But I think, yeah, we'll be watching those carefully. I know ourselves and others are at, you know, 60% or 60% plus at this point in terms of gearing. But I mean, it is government backed to a large extent with the P&A system. So, you know, in another context, I mean, the likes of some banks and even the HFA are not overly concerned about a gearing of possibly 70-80%, and I know we've seen that elsewhere. So, you know, we'd hope that there would be a reasonable approach to it, that is a risk-based approach, and that is what we're hearing so far.
Yes, well, since we've ventured onto risk and possible failure, I mean, the background to the success of the UK funding structures has been an implicit government backing. Antoine, there have been 1 or 2 failures of housing associations in the UK?
Not really, actually. Right now, they're speaking about one, but it's tiny.
Yeah.
So it's not really relevant. And there was one maybe 15 years ago, but a big one took it over at about the same time. So it's very important for the sector that it's got a history of no default, and that's gives a lot of credibility and insurance to the investors, having this very good history.
But on the downside to the state, or as maybe ABRA as regulator, they may see that they're effectively acting as lender of last resort for housing associations, and that if things go wrong,
you're right. I mean, so what we do, the regulator will step in before it goes too bad and try to sort it out. It's not explicit. It's interesting as well. Rating agencies make their own opinion about what would happen. And interestingly enough, I mean, in Northern Ireland, I think it's Moody's who said that they expect even the government to be even more supportive of housing association than in England. So after discussion with regulators on that, so it's it's very important.
When there is a government in Northern Ireland, which isn't constant. So Sharon, actually on Oaklee, another model entirely, which we haven't really discussed, public-private partnership. Oaklee was part of the winning consortium for the social housing PPP Bundle 1. So could you describe Oaklee's role in that project? There were others involved. So what did Oaklee do?
Yeah, the consortium is called Core Housing, COMHAR, an Irish word. And Macquarie are with the project lead and raised the equity. Sisker, the builder, John Sisker Co, the construction company, and Works Co, as it's called in the PPP structure. And in the Choice Housing Group that we're a member of, Choice Services is the FM contractor, and Oaklee is the tenancy management contractor in the consortium. So our role is to act as a landlord, really. So we do the tenancy management part of it and the community development bit. So the work with communities, establishing residents associations. So I guess it's standard practice that we do. So, allocations, tenancy management, rent collection, that sort of stuff. Obviously, it's a commercial contract with deductions if you don't perform. So it's much, I guess, it's different in that sense, and really does make you perform. And the reporting and accountability requirements are an awful lot more onerous than other work that we do. But it's been, our experience of it so far has been very positive, and we have learned an awful lot in the process. And we would see, I guess, one of the things about obviously balance sheets and government balance sheets and AHB balance sheets is this allows us to meet our social purpose, our mission, to deliver and provide social housing and tenancies for people who otherwise couldn't afford them, but also not put the pressure on our government balance sheet or on Oaklee's balance sheet or the government's to enable us to do that. So I think PPP sounds like it's here for a while. We know there's a bundle 2, which is just, I guess, I think some of the sites are still being constructed, and bundle 3 is about to be.
So will you be going for bundle 3?
Oh, I think we will. Yeah. So far,
it hasn't been that bad an experience.
No. It has been a positive experience, and we definitely will be going for bundle 3. Yeah.
So you talked about developing SPV or developing AHBs. We've both used that term. So from your point of view, an AHB like Oaklee is a developing one. What does that mean?
I think, well, I guess we have a focus on delivering more homes. So that I guess is a developing bit where I think it probably is a term that the likes of the HFA uses, the banks use. We're growing, we're taking on more debt, we're growing our business, our our balance sheets, our turnovers, and all of that from a financial point of view. So
meeting an increasing share of the
demand,
supply, of the need.
Yeah. And I think one of the things that we've seen from what's coming from the regulator at the moment, there's a categorization of tier 1s, tier 2s, and tier 3s.
Yeah.
They're going to have a category that they're talking about having 4 categories, and one is a growth category. And I think developing AHBs will be known as that new name, whatever it is, when it comes out. I think in terms of SPVs, it'll be interesting. I know Antoine mentioned it, the aggregator model, and whether that becomes a vehicle for financing, developing AHBs, whether we do these together, whether that's an option over the next while, because our balance sheets are under pressure, and even I think
clubbing together.
Clubbing together would. And I think even with consolidation of the sector and the possible development of group structures, this might be something that might, happen over time, that there might be SPVs within some of those groups that hold the assets. I don't know.
Yeah, very interesting. Thank you very much, Sharon.
David, if I just comment on that, aggregators, when we looked at that again when the financial crisis came in, and when speaking with the rating agencies, their view was always the same, that they would look at the weakest link. So you don't, unless you structure a lot the products, you don't get a great rating if you do aggregators. They will look at if you lend to 10 housing sessions, they will take the weakest one.
Okay.
That's going to be your rating. So it works if you really look at small sizes and you can't do it with your name, then an aggregator is useful. Like that, they can give you 5, 10 million. But as soon as you can do by your own name, then it's not really worth it.
There isn't a discount or a diversification advantage from an investor's point of view in a bundle of.
You would expect so. I mean, again, they diversify their risk, but they look a lot on rating, and on rating you don't benefit from that, because it's the rating method is not about how much you're gonna recover. The fact you are diversified, you will recover most. It's about, are you gonna default? And if one defaults, it can put the whole structure down. That's
what people are looking at. Fiona, my turn to you. So you're a recent joiner of Appian Asset Management. Can you give a bit of background on your experience in social housing finance?
Yeah, as you say, apologies, my voice isn't great today. I've joined Appian with just about a month. Prior to that, I worked with Centris Advisors, who Sharon mentioned in her piece, and actually Brian will be familiar with, because we worked with them on raising debt finance with Elgin. I worked with Centris from 2015, which I guess was the period that, as Brian said, the CAF and P&A model began to take off, and spent a lot of time working with HBs across a range of advisory roles, from treasury management policies, which is kind of one of the linchpins to really going and raising private finance, to looking at investment readiness, to funding option appraisals, to doing that market competition piece and seeing what was the optimal fit at a point in time for the HB. So I've had kind of very in-depth experience of fundraising and understanding investor requirements on the HB side. I guess prior to that, I actually, directly before joining Centris Advisors, I did an MBA, and I did a specialisation there in investment readiness in social enterprise sector. So it fitted very well with working with AHBs on raising private finance, and going from charity funding and capital and grant funding to becoming investment ready. And prior to that, I'd worked with banks like Depth and Dexia, which Antoine, I guess, kind of slightly alluded to in terms of the pre-financial period, would have been some of the largest public sector and infrastructure lenders in the world, would be funder of housing associations. So I worked on loan origination and property or portfolio management in both those roles. So kind of feels like my career has kind of been slowly ebbing me towards all the skills I need to take up this role in Appian and focusing on loan origination fund.
Yes, so the loan origination fund. So Appian and Burlington together have undertaken a variety of successful real estate investment funds in office, retail, industrial logistics. but the loan origination fund is different. Can you explain the borrowers and projects it's aimed at?
Yeah, as you said, Appian and Burlington Real Estate, who are a property manager, have worked together on a very successful and kind of awarded property fund since about 2016, 17. And I guess, building on that success, decided to look at other sectors within the real estate market. And I guess like a lot of investors, saw the attractiveness of the social housing sector in particular, with supply demand imbalances and requirement for, large scale both housing and funding to go into that sector. I guess the other important piece of the puzzle is the credit union side, where since 2018 the regulator has allowed them to invest into tier 3 social housing, providing loans of 25 years, but they need to do so through a regulated investment vehicle, which the Appian Burlington Real Estate Fund is an ICAV, and if you know ICAVs, you can set up different sub-funds within that, different investment themes, and each of those are regulated separately. I guess the other piece here is that Appian is, kind of a long history of kind of conscious capitalism and capital. It's been an impact investor with an impact fund since 2016. So bringing together the pieces of having the regulated investment vehicle, which the credit unions need, having the kind of relevant experience in the real estate market, and having that kind of social sector, kind of started some initial discussions with the credit unions to establish the appetite and I guess the need really for that investment vehicle. And that was kind of the genesis of where the fund idea came from. The regulation are quite prescriptive though, in terms of what the credit unions can invest in. It's a piece of their liquidity reserve, so it's relatively cautious. It's a 25-year investment maximum, and it needs to be through that investment vehicle, I guess, to protect the investor.
So from the perspective of your AHV borrowers, what is attractive about the loan origination fund?
Yeah, well, I think there's been a long history of, trying to make this marriage between the credit unions who've got pools of capital that they want to invest in a socially conscious kind of community-driven way for their investors. On the other side, AHBs are providing homes and want to be able to access that kind of, ethical investment who have aligned interests. And therefore, being in the middle and creating that investment vehicle that facilitates that flow of capital between the credit unions into the AHBs, should be attractive in itself. And I guess, the important bit is that, we see ourselves probably as an aggregation of credit union investments, because what we're talking about is a relative, the totality of what they lend could be 600 to 700 million, but any individual credit union within that is limited to kind of 5% of their liquid reserves, which is relatively small figures when HBs are going to market looking at facilities, as Brian and Sharon have talked about, in the region of 50 million at a clip. So we're kind of going to target somewhere in between, probably be 25, 35 million maximum borrowing. But I guess as Appian, and particularly with me coming on board, I've worked and sat on the HB side of the table, sold the benefits of the funding model and the sector, and understand some of the difficulties of the standard documentation and processes that bringing in institutional funder and then kind of bank funding with LMA requirements in can present. So we're kind of hoping that we'll be able to simplify down that model and actually probably more aligned to a HFA type documentation and process. So it's kind of a much easier move away, I guess, from the funding that they're used to, but provides them with an opportunity to diversify away from the HFA with a kind of long-term friendly investor.
So you personally joining Appian isn't the only big move recently. Yeah. Appian is itself in the process of joining the Gresham House group. So yourself and Antoine will imminently be colleagues. Do you see any opportunities there to deploy some of the UK experience to the wider group in the Irish market?
Yeah, definitely. I guess to begin with, just in terms of the loan origination fund, obviously having Antoine and the wider trade risk team is going to be very valuable as well, in terms of the credibility and the expertise they can bring in terms of structuring and ratings analysis and ongoing loan management. But at a wider level, Gresham has just under €5 billion worth of assets under management. Those assets are in funds which have themes around infrastructure and real assets. Obviously got some housing fund exposure and forestry. So very socially minded, ethically focused investor. Prior to Appian, as I've said, has kind of got that social ethos in terms of the impact fund and interest in forestry and those type of real asset sectors as well. So the idea will be obviously that Gresham House will be able to use Appian to kind of expand into some of those sectors and themes in the Irish market, with the loan origination fund being the first of those.
So I'll throw a general question to you, if you feel like answering it, and to the others likewise. Are there any of the recent developments that should be causing concern to the private sector, the voluntary sector? I'm talking about the policies that seem to be aimed at curbing investment demand for institutional investors in housing, as in houses, apparently not apartments. Are there reasons to be concerned, or is this a suitable way of directing capital to more useful ends?
Yeah, look, I think, you mentioned the Davy article that's come out today, saying we need 200,000 units. Sharon mentioned as well, the need for government can't do all that alone. Government needs private capital. So the need is definitely there. The need for private finance is there. It's a big enough market, I think, to accommodate lots of different investors. I guess what the recent policy changes, as we see it, probably have tried to do is differentiate between what everyone talks about as kind of vulture stroke cuckoo funds versus good capital in the form of dove funds. And I think anyone who's kind of heard one of our board members, Pat Cox, talk in the past will have heard us describe ourselves in Appian as dove funds, i.e. we want to, get ethically and kind of socially conscious capital married up with investors, where we don't want to kind of deliver excess returns. We want to deliver fair returns to the...
Please type your questions into the Q&A box there if you'd like, and we can try and get to them. Any of the topics we've discussed now, we've covered a wide field, all on the financing theme, but AHB regulation, private sector models, structures, public markets funding for voluntary bodies, PPP. So if you want to throw in a question there, we can come to them. Antoine, was there anything that you wanted to address in the... I see another one. There's a fresh one here for Antoine/Fiona. There's a high level of internal preparation that an AHB issuer would need to undertake before doing a first issuance. So you talked about getting a rating, internal governance, getting the financial statements in the correct format, audited. Is this really more onerous for than for bank financing? Talk in terms of the lead-in time, how long you'd advise an issuer to budget for in time, etc. So just a bit of pushback.
To comment on that, I would say that if you do look for long-term funding, even with banks, you do need to give quite reassurance about your business and the strength of the business. So I think it's not so much more onerous. If you do development debt with bank, is very expensive, and they look at all contracts with all contractors in your business, and that can be, I would say, even more onerous. We are doing some development debt at the moment, and normally a bond would take us, 3 months, and this one is taking us like 5 months. The rating we see as something as anyway, even before going to the market, is something to develop. It will come at some point. People will have to be familiar how they are perceived by investors. Is good to know. It shouldn't drive the full business. Because you don't need to be AAA. To run a business, but to see the creditworthiness of your business is a useful factor, and we've done many ratings, shadow ratings, long before going to the market, just to for the entity, I mean, to be comfortable and see where they stand. And I think that's a valuable tool.
Okay, another question coming from Russell Chapman, wondering why gearing might be such an issue when the fixed term loans are backed by guaranteed income through state P&A agreements. So maybe a question for the AHB leaders on the panel.
I think it's our view. I mean, Sharon had mentioned this issue with the regulators, but for us, it's more an issue for the lenders, and really shouldn't, we think, involve the regulator. I mean, the regulator is there to make sure that our entities are stable, that we're good businesses, that we're sustainable businesses. But it's really up to individual lenders, the HFA or LGIM or whoever it might be, to fix that gearing and to judge whether a gearing is excessive or not.
Yeah, I'd agree with that, and I guess that's why we're hoping that the approach won't be these hard limits as such. Because I mean, when you go for long-term finance, you're assessed, you produce your information memorandum. You know, it's a rigorous process and backed by P&A and all the valuations and everything. So, yeah, I don't think it is as big a deal as perhaps, you know, it's been perceived to be by the regulation officer, by some AHBs.
I guess, David, just from my perspective, having talked to a lot of funders in the market and sitting in that seat now, my sense of that is that it's probably a hangover from pure corporate lending, as would have been seen in the UK market, where you're looking to the strength of the balance sheet of the individual borrower, and therefore 60% would be perceived to be quite a high gearing limit. But definitely where we've worked with institutional investors, and we'll be able to take these type of views, knowing that credit's properly in the local market, in the loan origination fund, is that you look at what the gearing is made up of, and it's debt that's underpinned by cash generative assets backed by government. Therefore, you can tolerate a much higher level of gearing, not far off maybe where you see PPP transactions with 92-95% gearing, because of that strength of the cash flow and underlying asset.
That's great. I don't see any new questions coming in, and you never get punished for ending a webinar early. So just remains to thank each of our panelists. Thank you so much for a really stimulating conversation and some new ideas and thoughts there. And ask everybody to stay in contact, sign up, and we'll have hopefully some more webinars on other aspects of the social and affordable housing conundrum in the weeks to come. So thank you very much. Thanks.
Thanks.
Thank you, David. Bye.
Thank you.